There is an old saying, when Buffett sells, it's time to sound the alarm. This is more folk wisdom than economic theory. But there is something more to it. Warren Buffett, nicknamed the Oracle of Omaha, has adhered to one simple yet ironclad strategy over the decades of his nearly century-long career: buy, hold, and almost never part with assets, especially businesses. He built his empire like a watchmaker, methodically, unhurriedly, avoiding fuss. All the more surprising is that today Buffett is preparing to part with Berkshire Hathaway Home Services, one of the largest real estate companies, acquired by him at the peak of past market booms. What is this? A simple reassessment of assets or something more? Perhaps it's a warning, a quiet but powerful signal that's easy to underestimate. A global commercial real estate crisis. On one hand, it's not much of a sensation. Buffett has previously admitted to mistakes in real estate valuation, calling the acquisition of Berkshire Hathaway in the 60s his biggest mistake. Selling the asset today might not just be a signal, but an acknowledgement that even the Oracle sometimes errs, albeit rarely. But to truly assess the scale of what's happening, it's important to remember the last time Buffett sold a business was in 2020. Back then, it was an old newspaper company, and now, an exit from the real estate market. At first glance, everything seems simple: lost interest, decided to sell. But behind this apparent straightforwardness lies something much deeper. It's not that Buffett suddenly became disillusioned with the housing market. Rather, he sensed changes, a subtle but fundamental shift in the very architecture of the real estate business. The model that the industry relied on for decades has started to falter. Like an old machine, the engine still runs, but it rattles, stalls, requires more and more effort, and yields less and less output. Efficiency is declining, and the old approaches no longer yield the same results. The Blackstone Fund recently launched the largest distressed asset fund in history, amounting to $30 billion. This clearly indicates the expectation of large-scale problems in the market and confirms the presence of players intending to profit from the downturn. And this is precisely the signal that Buffett, as one of the most insightful players in the field, simply could not ignore. In the United States, the commercial real estate market is collapsing at an unprecedented rate. Nearly $500 billion evaporates annually. These are not just numbers and reports. These are buildings, investments, jobs. A wave of unpaid debts is already on the horizon. In the coming years, about $1 trillion are due for repayment, and more analysts are acknowledging that a significant portion of these loans will not be repaid. Today, on average across the country, between 18 to 20% of office spaces are vacant. This is not a temporary phenomenon. It is a symptom of chronic oversaturation and a systemic shift away from previous work formats. The pandemic has established remote work not as a temporary phenomenon, but as a new reality that has permanently changed the office segment. Half of the U.S. workforce prefers a hybrid model, and this is permanently changing the demand for offices. On the other side of the Atlantic, the same alarming picture is emerging. Germany, the heart of the European economy, is experiencing the sharpest drop in commercial real estate prices in a decade. Developers are going bankrupt, construction projects are stalling, and capital is flowing out. The central bank is tightening monetary policy. The cost of building materials is rising. The Chinese crisis began earlier and developed more rapidly. There, the very model on which the industry was built collapsed. Build now, sell later. Continue building with proceeds from new sales. This scheme could not withstand the pressure of debts. The government is trying to catch the falling structure, introducing subsidies, and encouraging banks to refinance. But trust has been lost. Prices continue to fall. Skyscrapers are empty, investors are leaving. And most importantly, there comes a realization: endless growth is impossible even in a country with 1 billion people. Against this backdrop, the Russian market appears almost stable. After the departure of Western brands, domestic companies quickly occupied the vacated spaces. New construction has almost completely stopped, and this, strangely enough, has helped maintain a balance between supply and demand. But this stability is illusory. Beneath the facade of normalcy lie decreased investment activity and a key central bank rate at 21% by the end of 2024. In such conditions, large projects lose their meaning, the economy doesn't add up. Developers prefer to wait. Development comes to a halt. The housing market situation is alarming. At this stage, the question seems quite reasonable. If markets are collapsing and industry titans are retreating, isn't it time to reconsider old dogmas? Is the truth that real estate is always valuable really so unshakable? Or are we witnessing a historical turning point where concrete and brick cease to be synonymous with stability? Commercial real estate is already engulfed in the crisis fire, but the echoes are beginning to shake the residential sector as well. The old logic, if it's expensive, it means people are buying, no longer works. A new reality is increasingly common, expensive, but inaccessible. The rise in rates has drained mortgages, thereby deflating the bubbles that were inflated just yesterday. But housing is not just an asset in a portfolio, it's an archetype. A home as an idea, as a dream, as an ingrained cultural norm. And when the dream becomes unattainable, society changes along with the market. Mortgage rates have almost doubled, from 3% to 6.8%, and in some places, to 7%. For the average American family, this means a sharp increase in monthly payments, by hundreds, sometimes even thousands of dollars. Loans that not long ago helped bring a home closer now push it further away. The mortgage has turned from a bridge into a barrier. The paradox is exacerbated by the fact that sellers are also in no hurry. Millions of Americans who locked in low rates during the era of cheap money do not want to lose this advantage by entering the market. As a result, there is an almost complete disappearance of supply, frozen demand, and prices hanging in the air, neither going up nor down. The market is blocked. In China, the housing crisis is developing differently, not as an explosion, but as a slow erosion. Prices are decreasing month after month, over 3% down for new constructions, 7% down for the secondary market. But the main blow is to confidence. Millions of Chinese invested in apartments that were never completed. Developers went bankrupt, construction projects are halted, mortgages continue, but there's nowhere to live. The government is hastily allocating loans, urging banks not to pressure developers. But it's already too late. People have stopped believing, and a market without trust is like a building without a foundation. Against this backdrop, the Russian housing market seems surprisingly stable. Different laws apply here. The government actively subsidizes mortgages, supports developers, and regulates demand. In 2023, prices for new constructions increased by 6 to 7%. The secondary market is stagnant, especially in Moscow, where in 2024 the cost of housing has hardly changed. Why? The answer lies again in a paradox. Mortgages for the secondary market are inaccessible. Demand is decreasing, but sellers are not willing to lower prices. Developers, receiving support from the budget, continue to increase sales. As a result, the market has two speeds. One half is stalling, while the other is artificially heated. But it's important to remember, stability fueled by subsidies is not strength, but a postponement. As soon as government support weakens, the market may find itself face to face with the reality it has been avoiding for so long. Calculating the consequences of the crisis. Can we talk about a single global housing market? Unlikely. The conditions, regulatory mechanisms, cultural and economic traditions are too different. But despite all the diversity, there is a common direction, a vector set by the rate. Everywhere money became expensive, the housing market was the first to be hit. In some places, this caused a price correction, in others a freeze, and in some, a crisis undermining not only the economy but also the social fabric. The first and most significant blow was dealt to the banking system. Mortgage portfolios, construction loans, collateral obligations, all of these lie on the bank's balance sheets like cast iron slabs. When real estate prices fall and borrowers can't pay, the balances start to leak. The banking system loses stability. The second effect is less dramatic but no less significant. The economy stops building. Developers put projects on hold, banks refuse financing, and governments hesitate. But construction is not just tower cranes and concrete, it's a chain. Workers, materials, equipment, furniture, electronics. It's a stimulus for a whole range of industries. In Germany, for example, construction and the real estate market account for about 20% of the gross product. 1 in 10 people works in this sector. When construction halts, companies go bankrupt, demand disappears, and the largest economy in Europe faces systemic risk. In China, the dependency is even deeper. According to various estimates, up to 29% of GDP is directly or indirectly related to real estate. The collapse of this model has dealt a blow to the entire economy. The International Monetary Fund has already lowered its growth forecast. Analysts warn, if the market is not stabilized, the consequences will be long-lasting and devastating. There is also a third, less noticeable but quite tangible problem: budget depletion. In many countries, especially at the city and regional levels, a significant portion of income is generated from real estate. In China, for example, local budgets directly depend on the sale of land rights. If developers leave, the income disappears as well. This is followed by deficits, program cuts, freezing of infrastructure projects, and salary reductions. In the United States, this process is unfolding in its own way. Cities like San Francisco, where office towers stand empty, are losing revenue from property taxes and are deprived of business activity. This doesn't cause an immediate collapse, but it creates a cumulative effect. The budgetary base shrinks, but the obligations do not disappear. A quiet crisis begins, financial and managerial, and potentially social in the future. In Russia, the situation currently appears more balanced. The government is actively spending on infrastructure, supporting demand through benefits and mortgage subsidies. This allows the construction sector to stay afloat. But even here, there are limits to resilience. The decline in activity at construction sites is already affecting revenue from value-added tax and corporate tax. And the mortgage support itself is turning into a constant burden on the federal budget. More noticeable with each quarter. The home as a mirror of life and the economy. It's important to remember, real estate is not just a physical object. It's a symbol. It's a feeling of well-being. For most households, housing is the largest asset. When its value increases, people feel wealthier, more confident. They are more willing to spend money, undertake renovations, buy furniture, and upgrade appliances. But when prices go down, even if incomes remain the same, anxiety arises. What if this isn't a temporary drop, but the beginning of a crash? And then saving begins, postponing major purchases, scaling back plans. The economy enters a waiting mode. This effect is especially noticeable in Europe and China, where the decline in prices has become a persistent trend. Millions of families are watching as their main asset loses value. The answer is simple: cutting expenses, freezing projects, restraint in spending. There's a decrease not only in the demand for new housing but also for everything related to it, from door locks to kitchen appliances. In Russia, despite the nominal price increase, especially in the new construction segment, the feeling of inaccessibility is already here. Mortgages for secondary housing have become unaffordable. The buyer is waiting. Developers continue to build, but demand is increasingly fueled by government programs. And this is the main, yet often elusive result: the slowdown in the velocity of money. Money comes to a standstill, and with it, economic dynamics. When the market is waiting, growth is postponed, and sentiments change. The American dream, a cozy house with a lawn and a mortgage at 3%, is a thing of the past. Today, the rate on a 30-year loan is approaching 7%. And this means that monthly payments have almost doubled. A mortgage, which was recently affordable even with modest incomes, is now becoming a luxury. Young families, as well as so-called first-time buyers, are effectively pushed out of the market. They don't have the funds for a down payment and can't service new loans. Those who already own homes find themselves trapped. Selling isn't profitable, and buying new is impossible. Thus, the phenomenon of locked-in owners has emerged. A person can physically move, but economically they cannot. It's a closed space where movement is blocked by rates. Renting remains. Yes, it becomes a way out. But the massive influx of renters drives up prices. Living in cities has become noticeably more expensive. Financial pressure is increasing. Attitudes are changing. More and more people no longer see owning a home as an achievable goal, and life stops being perceived as moving forward, step by step, up the social ladder. In China, real estate is not just a roof over one's head, it's part of the cultural code. Having your own apartment is almost a prerequisite for marriage, a symbol of adulthood, status, and reliability. Therefore, the crisis of trust in developers is not just an economic catastrophe, it's a cultural trauma. Thousands of families continue to pay mortgages for apartments that may never exist. Millions are watching as their only home loses value. Tens of millions are beginning to question whether owning an apartment is truly the goal. Young people in China are increasingly rejecting the traditional model: study, work, marry, buy a home. Instead, a new, different mindset is emerging: rent, live, spend on yourself, don't get attached. This is a shift not just in strategy, but in worldview. And perhaps this is where the true boundary of the current crisis lies. The market has collapsed not only in numbers, but also in perception. Investors. Investors and developers, as always, live in their own time. They are not so much focused on today's crisis, as they are on tomorrow's opportunities. Some are leaving, saving their capital, while others are entering, looking for the right moment to strike. Funds like Blackstone first limit withdrawals, then start selling off assets to free up liquidity. Creditors are rushing to clear their balances of toxic debts. Developers are putting construction projects on hold, revising plans, and simplifying layouts. Apartments are becoming smaller, cheaper, and more practical. The main thing is that they are being bought. But at the same time, a new layer emerges: the so-called crash hunters. These are players who go where others are fleeing from. They buy up buildings that have lost value, acquire collateral portfolios at auctions, and invest in markets where a cleanup has begun. Someone buys a skyscraper in New York for next to nothing. Someone else buys a bankrupt shopping center in Berlin. They are not afraid of blood on the streets. They think in a 5 to 10-year horizon, counting on a triple return. In their logic, a crisis is not an end, but an entry point. A strategic purchase where others see only losses. Russia is a separate story. Here, a unique process of buying up assets abandoned by Western companies is underway. By law, with a discount of 50 to 60%. Those who have access to resources are the ones buying up. Those who don't are looking for returns elsewhere, in apartments for rent. The demand for passive income remains consistently high. In conditions of limited choice and high inflation, real estate remains one of the few tools for capital investment within the country. And while other markets are in shock, here the principle works: slow and steady wins the race. Why is Buffett moving to cash? The situation where a hunt for depreciated assets begins is not new in itself. But against this backdrop, Warren Buffett's behavior stands out particularly. In 2024, his investment company began moving into cash at record speeds. Such a rapid shift to cash wasn't recorded even during previous crises. And importantly, this maneuver started before Donald Trump's loud statements and before new upheavals on Wall Street. Coincidence? Perhaps, but too precise to ignore. Today, the stock market directly depends on budgetary infusions. Government spending accounts for a third of the gross domestic product, and any reduction in this support will inevitably hit the markets. The first signs are already noticeable. Air travel is decreasing, layoffs are increasing, and consumer expectations are worsening. Buffett is leaving not because real estate will collapse, but because he understands the market has changed. It's no longer digital transformation, but a simple yet powerful compression of demand that's breaking old business models. Those who cannot adapt will not survive. Therefore, his decision is not panic, but a calm reassessment. Or perhaps, foresight. And here arises the question: if a person who is famous for his ability to see through decades suddenly exits a market where he has been for decades, is it a warning, or just a coincidence? Don't miss the chance to get rich during a crisis. Any crisis is not only destruction, but also a pause, a space before the next act. At this moment, markets freeze, players wait, governments delay decisions. Everything stops, like before a breath. It is at such moments that it is especially important not to miss the direction. Real estate is an inertial giant. What will happen next? A sharp rebound upwards, or a prolonged stagnation stretched over years? There is no answer yet, but everyone is eagerly waiting for it. From bankers to young families, from construction cranes to ministerial offices.